Hello, Warriors. I know everyone has a lot of interest in tonight's debate, presidential debate, but I can't see it being any more compelling than the debate on Trader Summit between Peter Schiff and Danny Blanchflower.
That was brilliant.
And where the moderator lost complete control.
That would be me.
And Blake had to step in with some type of timer. And
yeah,
you
I had to use
guys,
my phone.
it's a classic. So, if you're excited about tonight, you got to go check that out. I'm sure it's on video out there somewhere.
Oh,
Anyway, it
God.
led to the retirement of Danny Blanchflower. And anyway, here in F.A.C.E, we start careers, and on a Trader Summit, we ended one. All right. So anyway, how's everyone doing today? Hi, Mike and Sinatra. That's the advantage of being somewhere for a long time. There's lots of good material that accumulates over the years. All right. So any big news? AJ, hi, Ryan, Ingmar, Richard, I hope you feel better. Brand, I hope you feel better soon. And Kurt, how are you? So we have a little weak bounce in currencies here. What are you thinking, Ryan? Just, is everything going to come down to this number tomorrow?
Yeah, that and end of month.
Yeah.
It's one of those days where you jump in the boat and go wherever the tide takes you. It's no good trying to row upstream because you get a move and it just goes the other way. Yesterday's fix, everything was dropping, dollar was rallying. But the other way round, hour before the fix, half hour before the fix, and over the fix, it all went the other way again. Now we're sort of back where we sort of started in quite some pairs, but dollar yen's getting absolutely trousered. We had Kanda out yesterday, and he managed to send it down for about 5 minutes, and then it made new highs. So we're banging to full-on intervention watch now.
Okay. Dollar index. Yeah, there's a little divergence. I don't have, I think tomorrow's the day. But we're either going to break out of Blake's formation or fail because here's the Dixie. So I don't think we're that far away from where you would have a breakout, correct, Blake?
I'm sorry. I'm sorry. I was just responding to poor Brand. He's sick, but he's still here. What were you asking me, Dale?
We're not that far away from a breakout of your
in the
formation in the dollar. Yeah.
No. It would be 106.25 if I'm not mistaken. 106.25, I think, is the number that it's the 88% retracement and also should be that triangle resistance. I was reading I forget what bank technical report. They're looking at the same thing. Everybody's looking at it. It's the bottom line is everybody's seeing the exact same triangle that we're looking at. So that's what's going to make it a big deal, I think, following this French election, because everybody's anticipating that there's not going to be this big majority of the left, which if there is, the market might panic a little bit. We could see some euro, the euro trade below 106, and then that would in turn put the dollar index in breakout territory. But no one expected the French, what happened in France to happen. So no one's expecting the majority either. So we'll see. But anyway.
Okay. Well, I could see 105 if we fail from these levels. These are pretty important levels. This was 78.6 back of this. So, we've had quite a few days in this range. Tomorrow's the day, I think. But of course, you say the elections, but it's an inflation number tomorrow, isn't it?
Yeah, PCE. I was going to say,
and as Kman's been talking about all week, it's end of quarter too. So there's supposed to be a lot of dollar selling flows, like that might be getting through the market at this moment too.
Well, showing up in gold. Gold's very stubborn, still holding support. Silver, maybe it's okay. I don't know. I think there's still one more shoe to drop in gold when you look at this. It looks like, we're getting a bounce from support, but I still think it wants to challenge us high, and that'd be perfect buying opportunity. A lot of people are going to turn negative under 2280, and we get some type of liquidation, and it breaks another 30-40 bucks, and that may be the time. So I'd like to see him take out these stops. People start calling this a head and shoulders, which would 2440 would measure all the way back to the breakdown, which I don't think we're going to get. And if we get that, then there's something else going on. So, I'd like to see one more flush and take the miners down one more time. So the miners I'm looking at, it's GDX is a pretty good barometer of it. And again, people are saying head and shoulders top, but I'd like to see halfway back is 3150 and 61.8 back is 3018, which is where the 200-day is. So, I mean, this would be a back up the truck entry for me. So, S&Ps, are we going to make one more high? I think Jim Welsh thinks we can. Here's NASDAQ, maybe, but the Dow's still struggling. And one other trade I'm waiting for is, which would imply the S&Ps could rally one more time, would be to take the VIX down to 12. And I'm going to get long vol down there, should it happen. And I would think that would happen if the dollar weakened, not strengthened. So we'll see. And it doesn't have to. Maybe it's just going to be a two driver and take off from here. But down here, I'd pick up some vol. Also, got a tweet from Ben Maldonado, and Ben's cycle work is pretty good, and he's focused in on late August, early September for a high in the market. So, you think about it, sounds like a long way from here, but it's only 2 months. So we'll see what kind of upside. A lot of people have been talking 6,100 for a long time. Maybe in the next 2 months it has a chance to get there. So anyway, I thought I'd let people know because Ben's worth following on his cycle work. So that's about it. I think it's important what happens here. I thought 10-year yields could get to 434. They did. I think this is pretty good resistance, if it gets through here. But this to me is really an important line in the sand at 420 on the 10-year yield. Kind of has a look of a descending triangle. You draw a trend line here, something like this, and you have your descending triangle. And that measures 50 bips. So 50 bips under here, 420 is going to be 370, under this low. So to me, that's the important line for a continuation of lower yields. And TLT is pulled back, but it's trying to, on the 4-hour, it looks pretty ugly, doesn't it? But on the 4-hour, maybe this is just a pullback and we're going to run again. So keep an eye on yields. I think that's a story for a lot of different markets here. And I still have to give the benefit of the doubt to the upside. It hasn't been a terrible correction in price. It's been more like time. Couple of weeks of moving sideways and then taking out support to maybe shake some people out back above that 93.5 level. It's going to look good again. So still constructive on the bond market. And I think that's
Good
about
morning, Dale.
it.
Good morning, everybody.
Hey, Kay, how you feeling, buddy?
Not too bad. Regarding those bonds and equity markets as well, I think we still have to take into account end of quarter, end of semi-year, because there may be some decent rebalancing done, and I wonder, because the yields went up without too much of a reason, that we may already be in that play, you know. And I think to really judge what's going to happen on yields and things, we should wait for the PCE tomorrow, and then perhaps even next week, once all that rebalancing is done, you know.
Yeah, okay. I mean, so far this looks like just an oversold bounce, you know, corrected this decline a little bit, but really that 420 level is big. That's the way it's showing up for me technically. So
oh yeah,
we'll see.
it is. But we will see next week, or even after tomorrow's PCE. I think in the meantime, it's more driven by all those rebalancings that are going on. Yeah.
Okay, and we also had what's interesting. We had some bank stress tests yesterday, and you know, the statement was they all did well, but you know, Goldman took a hit on it, and I
All good
think,
for government work.
yeah, I think Wells did. The banks that service the smaller customer and have credit, revolving credit with the, you know, the renters, the serfs in today's society. Um, they, you know, they did less well on the stress tests. I'm going to ask Peter Bookvar later, you know, if he has any comment on it. How about you guys? Did it mean anything, or is it just a show? Or are regulators a little bit worried that if we have a slowdown in consumer spending and these, you know, the balance sheet of consumers continues to deteriorate, that they're going to have some credit problems and they want them to prepare for it? What do you guys think?
I don't. I think it was just the normal stress test being conducted, and because they are scheduled, aren't they? I mean, this wasn't a surprise thing, but they all showed that that they can sustain any type of recession. So that was the positive that I overheard anyway.
Okay. Because I think XLF is another one of the ETFs that is not making new highs with the market. So, you know, you look for groups that, you know, are showing some weakness. Amazon just blew the cover off the ball. I was looking for a 3 driver in Amazon, but when it comes out of a 3 drive like this, I have to leave it alone. It's still diverging, but that's a pretty good candle.
Why you know, Dale, you've been sitting here talking about selling it at this you know, on a new high. You got it. You know, sometimes they tell you the best trades you can make are the ones that you throw up. At
the one, your original thought, and then something will come along and you'll hesitate.
No, I know, right? You know, and that's the thing is when you're looking for things to happen, the time it takes for an instrument to get wherever you think it's going to go does matter.
Yeah,
for sure.
And it's the size of the candle. I mean, compared to everything prior, it just looks, you know, pretty powerful. If it would have just grinded up, it would have been different to me. So I guess the lesson is, and maybe I should be doing something here, but it's not the price at times, only the price, but how it gets to a price that's important, or a formation, how it fulfills it. And you know, right or wrong, that candle is too intimidating for me to short into.
And you know, Dale, there's a saying that that we have on the Morning Edge, which is the show following the F.A.C.E show here, is you know, big green candles are followed by more big green candles usually.
Yeah.
You know what I mean?
Yeah.
So it's hard to stand in the way of that for sure. So
and I, you know, I really don't want to get short anything else. And you know, I have some SQQQs, but I'd like to wait for just in case there's that one more break in the VIX to 12.
Yeah.
And then I may do some adding.
Well, the one thing about the VIX, and I want to say this, Dale, and I'm sorry I got to take over because we got a bunch of news coming out pretty soon.
Oh, cool. That's all right.
The thing about the VIX is I actually have been arguing the last couple week ahead videos that we're going to make higher lows, and I think volatility is set to start grinding higher a little bit. You know, as we round out this quarter. And so that's something that that personally I feel that we might not get that dip and in volatility. So I think we're just going to continue to grind out like higher lows. Anyway, I'm hoping that's the case because higher volatility is going to be good for all of us traders, right? Hey, so I want to go around just a few currency things just to make sure that everybody is on the same page when we look at, you know, like, so the euro finding support ahead of that really key 106 50 106.60 level. This is that major triangle support. Everybody's looking at the exact same chart, and I think you know, as we've been talking about here, the end of month, end of quarter flows that we're seeing are supposed to be dominated with dollar selling. So that could alone, plus we got data coming out, that could really get us back above 107, maybe 107, 20s or something in the euro. I would imagine that the market's not going to be too excited about playing the euro to the upside, but you might see more of a recovery, maybe in the Aussie or the Kiwi, perhaps. But Kman, there were some comments from one of the RBA governors that was a little surprising, right? Overnight.
Yeah, he was trying to counterbalance Bullock's hawkishness a bit, saying that they are not. We shouldn't be looking at one data point, and that there's still a lot of data to come out before the next meeting. So he was trying to counterbalance the expectations a bit for a rate hike possibly on the August meeting, but yeah, that's why the Aussie lost 10 pips or so in the process.
Got it. Thank you very much. And you know, just so everybody's clear, this is the post-COVID lockdown recovery multi-year trend line that's really weighing on the Aussie. And you know, you had this great, I mean, 0.2% higher year over year on inflation this week in Australia. You got a central bank. I was talking with Chris Weston from Pepperstone last night, and we were just discussing like what central banks are possibly going to raise rates. The RBA might, and the Aussie is still not looking great. And that's the thing that scares me the most about people that are probably piling in long Aussie dollars based on the RBA tilting more hawkish, higher inflation. You still can't get the Aussie above 67 cents. So that's just a, you know, if it can't go up, usually only has one other direction to go, especially after 2 months of sitting in this very tight consolidation. So just a little heads up. I'm becoming less and less. I've been in the camp that we're going to eventually break out to the upside, but I'm starting to get a little bit nervous about that. Just heads up with that. We also have Banxico today. Now, if you missed the 2-minute video I put in on the dollar mex yesterday, let me just give you a couple key technical levels here. Notice how the pullback has been contained to a 38% retracement. So if you think about that from a trend perspective, that is a very shallow pullback that, you know, usually results in an upside move. And now all we need is the next component of it, which would be, you know, some macro or data, or maybe election, more cabinet reshuffling by the incoming government that could put the Mexican peso under pressure again. But we do have Banxico today. Most economists are expecting rates to stay unchanged. But when you have the peso that is strengthened a little bit over the last week, and you know, if Banxico feels that the Mexican peso is going to continue to get sold, and they have to, you know, eventually cut rates, they might get ahead of that. And even though they're not expected to cut rates today, if they do surprise the market, we could be trading above 19 later today. So just, I don't think that's the case, but I think that is there's a very, very small possibility of them doing that. Now, Ryan, I wanted to jump in really quick with you and ask, we have all this data coming out today. We have GDP, unemployment claims that everybody's focused on. We have durable goods, GDP price index, a lot of data coming in today. What are you looking at right now in currencies?
Well, regarding the data, you forget GDP unless there's a huge variation. As I've been saying, we're just about to close off Q2, so no one gives a monkeys about old Q1 data. Durable goods and jobless claims are the ones you want to watch. And yeah, just see what it does for the dollar. What does it mean for the Fed? Does it mean soft landing? Does it mean hard landing? Those durable goods, they have an aspect of the consumer related goods, white goods, computers, electronics, that sort of thing. So it's another insight into the consumer, and just go with the flow, whatever the data is. If it's bad data, dollar gets sold. If it's good data, dollar gets bought.
Okay, well, we got a bunch to sift through. Kman, there was a headline about the BOJ and them making some phone calls around. I interpreted that as they're not going to do anything in the near term. So if you're long dollar yen, you can see how it's breaking out, or short yen, there's nothing really to worry about right now because they're just making calls, seeing where what everybody's thinking as far as bond buying goes, and where QT tapering expectations might be, blah 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 blah. How are you reading that headline that came out just a little while ago?
This is normal procedure. They do a survey with the market participants to prepare the meeting of the 10th or 11th of July. Sorry, where they are going to really sit down with the biggest market participants, and I suspect it's the mega banks, the GPIF, and the insurers and trust banks probably, to then decide during the Bank of Japan meeting on the 30th by how much they are going to cut the bond buying. The other thing, though, is that Uchida came up again. It's nothing really new, but he said that the weaker yen has an impact on prices, and we were talking about that on the Flow Show as well. I think timing is going to be pretty important. Let's say all else equal, if we don't get any stupidly bad news out of the US or the European Union that would weigh on yen crosses also, or on the dollar yen. I think timing, the first half of July may still be somewhere business as usual. That means tough to be long yen, sorry, for longer. But I think the second half of July things may hot up a little bit. Again, all else equal. Of course, we can have a very bad jobs report, for instance, out of the States, who is driving the dollar yen lower in the meantime. But I'm still not standing in front of it, but I'm going to get probably quite interested second half of July, and then see how it reacts, because we could have a double whammy, hiking rates and reducing the bond buying by the Bank of Japan, which would be an interesting dynamic.
Okay, and just looking at the charts, there's nothing really to be worried about right now. We're sustaining the breakout above 160, unless data really starts to roll over here in the US, which quite possibly could in 7 minutes, and then we see yields drop. Maybe that might have an effect, but other than that, you're really looking in the next couple of weeks.
Yeah, we've gradually raised the danger level. It was clearly 152. That's where it also stopped on the last interventions, and that bit of follow through the day after. Then we raised the bar to around 154.5, 155. Then it became 157. Now I think it's somewhere 158, perhaps 157, 158 is where the danger zone is now. So that's already quite big figures higher than where it was before. And that now is your first port of call, I think. And of course, we can never rule out interventions. I mean, imagine that we see a week a weaker PCE tomorrow, and the market is still buying dollar yen. They may they may come in and Kanda or Suzuki press a few buttons. You know, we can't rule it out. We are in danger territory for them to intervene. Although people think now the new intervention level is 165, but that's just blind darts. And I don't think we can stick a level on it at all. But yeah, I mean, in the meantime, for those who are short yen, they can raise their stops.
All right. Appreciate your input there. And just, Dale mentioned a little bit ago about gold. Yeah, interesting that move right back below 2,300. Buyers came in. This is the range that, it's a very, very bullish consolidation. Everybody should know a break below 2,280. I mean, that's you look for a range extension that takes us down to 2120. And until that happens, we're holding the range lows for right now. I think it would have to be data that drives us below that. Dale,
and I also think on gold, Blake, if we go back to look at the timing when we did the lows, it's all into around that fixing yesterday. I really think that metals also have fixings that we don't necessarily know about the rebalancing and stuff. But I've noticed that over the last days of the month, they are on the move as well. So I guess it must be somewhere part of a rebalancing act as well. And but I think the fact that we didn't go and test the 2280s may be telling for what's going to happen, right?
Yeah, I mean, it's whole. I mean, buyers are stepping in. They know where. I mean, that's the bottom line with the markets, right? If you know where you're wrong, that's the most important thing. Where's your risk? And so we get down towards 2,300. I think everybody's going to be buying down there until we break. So yeah, I mean, and they are definitely stepping in ahead of the key support. One last thing is crude oil. You can see how it's knocking its head up against the 618 retracement. That is a very bullish consolidation right now. Every dip to 80 is being bought. There's been a lot of people that have referenced that recessions a lot of times kick off with higher energy costs, and I can't figure out for the life of me why crude oil would rally other than positioning is really poor. Meaning there's a lot of funds, hedge funds, fast money that have been shorting crude, buying puts on crude, thinking that we're heading into a recession. I think just from a positioning standpoint, that could send prices a little bit higher, but I don't know. Maybe there's something out there that we're just not seeing just yet. All right, we got a few minutes before data comes out, so let's get ready for it. So I'm going to go over to ForexAnalytix, and I'm going to grab the data flash here, and we've got, like I said, so much data coming out. And then right after the data comes out, we hear from Ryan and Kman and Dale on how things, and I'll give you my input on how things have just come out. After that, we're going to have Peter Bookvar here. He's a really great analyst. You guys probably see him on CNBC and Bloomberg all the time. So make sure you stick around for that as well, for his interview with Dale. All right, so let's pull up the charts that do matter for this data dump that we're going to get. I'm going to pull up, we got the S&P intraday chart here in the middle. To the right, you're going to see the 10-year yield. I'm just going to go ahead and get that one zoomed in a little bit. You can see yields are very, 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 very perky today, by the way. And this far left chart, I'm just going to put in the dollar index, and I'm going to put in a 15-minute chart as well. And remember, the dollar index is not far from breakout territory, which is 106.25. I don't think that today's data is going to do that and push us out into breakout territory, but hell, you never know. I think people are a little defensive ahead of this weekend's election. As a matter of fact, oh shoot, we don't have enough time. We're gonna have to discuss this tomorrow, guys. Tomorrow, let's Ryan, Kman, Dale, let's plan on having a little bit of a discussion about the French elections tomorrow. All right, so make sure you guys are all here on F.A.C.E tomorrow so we can have a bit of discussion about this far left majority.
I'm voting for Pepe Le Pew.
Yeah, Pepe Le Pew. Oh man, how many people remember who Pepe Le Pew is? I do.
All right.
Oh, all right. Oops, where's the data?
Patrick remembers.
Damn it! I didn't mean to do that. Oh, here it is. Okay. Here we go. Few seconds. Heads up. What we gonna do when they come for you? Watch these jobless claims. Durable goods better. Weekly jobless claims better. Continuing claims a little worse. Revised higher though. Month over month durable goods. What is that? The core? What do you guys seeing anything here? GDP in line. Price index in line.
S&P's doesn't like it a little bit. Short term yields are testing
Consumer
highs.
spending a bit lower, but again, it's Q1 data.
Yeah. Trades bound. I mean, this all of it's fairly in line. Nothing to really get too terribly excited about.
Well, durable goods is a little bit softer on some of the components, even though it's the headline numbers beating expectations. So you take off transport and defence, which are the big ticket items, and it's all looking negative.
Okay. All right. So taking out the big ticket items, it's all looking a little bit negative, and I think that's given the dollar a little bit of selling pressure. And remember, again, this could, just open the door for a little bit of dollar selling, just as the market is anticipating dollar selling into quarter end. It was like almost a 3 standard deviation read from some banks. So just that means there should be a lot of liquidity coming in for the dollar. All right, well, not a huge reaction, but the dollar index is coming off a little bit. Stocks are S&P's. No, not minding a little bit weaker data, I guess. And well, that being said, Dale, I guess I'm going to pass it over to you, unless Kman and Ryan have any more comments here.
Not really. Business as usual. Yeah, I think month end, quarter end, half year end. Bring it on.
Yeah. All right, Ryan, you have any last minute comments here? I'm just looking around, by the way.
No, just looking at just watching the prices. Got some bits and bobs dollars on that I need to look at, manage.
All right, guys. Hey, then heads up for Banxico that's at 3 p.m. Eastern. I'll recycle that 2-minute video in case you wanted to get more in tune with the technicals on the dollar MEX ahead of that. And thank you all for joining us today. Make sure you try out ForexAnalytix. It's only $1 for 10 days to jump in our chat room. You can chat with Ryan, Kman, myself. Dale pops his head in there every once in a while, and and so many other traders are there. So come join us. It's a great community. Dale, I'm going to pass it over to you.
Okay, thank you, Blake. And
Thank
Peter,
you,
can you please accept being promoted to a panelist, please? Thank you, buddy. There you go. Peter, welcome back.
All right, Peter is here.
Thanks for having me.
All right.
Hey, great to have you, Peter.
Good
So, why don't we start with this? I follow your writings and the emails that you put out, Peter, and one question that really came to mind to me today, and I'm trying it. I've tried it. You're buying U.S. dollar yen, aren't you?
No, I actually like the yen here.
Yeah, that's what I mean.
Yeah. I think there's an extraordinary amount of pressure on the Bank of Japan to act robustly in July. I say robustly because they're probably not going to raise interest rates much. Maybe they raise them 10 or 15 basis points, not as much as 25. But I do think we see a bigger than expected cut in QE. I think that the Ministry of Finance does not want to be put in position of having to defend and constantly intervene, because we know and they know through experience that it never works more than just a couple of days. And I think that the Japanese people are getting pissed with the weakness in their purchasing power, with wage growth still running below the rate of inflation. And we're at an inflection point. So, it is a widowmaker trade potentially. So it's not something that you have to be too confident in until you see what the Bank of Japan does. But those are some of my thoughts.
Okay, so is something that you're considering. You haven't stepped in. Are there any levels
Well,
that?
I do have some yen exposure through. I recently bought 7-Eleven, well, the company that owns 7-Eleven. So that
Okay.
was my wussy way of getting some yen exposure.
Okay. All right, because I think there are some people talking 62 to 64 since we made new highs. On the daily, I'm seeing some pretty good divergence here. And you know what? A lot of people are waiting till mid-July. What if they do both? What if they try an intervention during the holiday period next week and then go ahead and back it up with some fundamental shifts like you were talking about?
I think
Maybe.
that I think they would actually get more bang for their buck/yen if they intervened after they raised rates, because you
I
could
see.
have, because there's no point in intervening, then acting monetarily and not satisfying the market, and that intervention was wasted. It's better to see, maybe react first with monetary policy, try to develop some momentum with the strength of the yen, then intervene to further that momentum. That's what I would do if I was running FX policy there. So, but
Okay.
I doubt they intervene prior to this meeting, but I could be wrong.
I mean, look at this. I mean, this last high in the yen on the weekly um, hasn't even gotten above 70, where you look at prior highs, the high on the intervention was above it. So we are diverging between a lot of highs here, getting some momentum, non-confirmations, but we still need a red candle, some kind of weekly red candle to confirm it, for the price to confirm. You have a view on yields here in the States, Peter? We've had a nice bond
I
rally,
Yeah,
the TLT.
I still think that the 10-year yield is going to be retesting 5%, the level that we saw last October. I don't think that this bond bear market is just magically over in a couple of years after a 40-year bull market. I think that there's a lot more wood to chop here on the long end of the curve. And whether that is because, while I acknowledge inflation is definitely moderating, uh, I don't necessarily think that that is sustainable. I watch very closely the weekly uh, container price index, and it just
Yes.
continues to spike. It's doubled, more than doubled, over the past 10 weeks. If you look at the Shanghai to Rotterdam route, it's doubled from Shanghai to LA. Goods prices, we know, on a year-over-year basis, it's back to its pre-COVID trend of basically zero. But I don't think we stay here, in part because of higher container prices. We've been in a global manufacturing recession for 2 years that
Yeah.
at some point will end, and we'll see some restocking. Oil's still remaining stubbornly here at around 80-ish. Now, on the flip side, we are going to flow through the weakness in rents we're seeing. That will slow the services side of the inflation story. But I think net, we're still in a 3 to 4% sustainable inflation rate. I emphasize sustainable because we're going to see two prints in the second half of the year, but mid to high twos. 3 to 4 to me is a more sustainable inflation rate over the next couple of years. And the other reason why I like tips here. And higher for longer is not just a worn out cliche, it's going to be for real.
Okay. Well, all I know is technically, Peter, if we take out 420, that's a huge level. If you look left that we held in the last week or so, that's going to be a breakdown to me. And that measures back down towards the lows of, 360. I don't know. Can you come up with a narrative that could get us there? You
Well,
can't, because
you
you
can
just
have,
laid out the case of why it wouldn't. But is there any narrative that would support the technical argument?
well, if we go into a deep recession,
Okay.
the flip side of that, though, is if you go into a deep recession, instead of having $2 trillion budget deficit, you're going to have a $3 trillion budget deficit. And as a percent of GDP, it'll be over 10%. And that the amount of supply can just overwhelm the market, and you can have a recession but higher long-term interest rates. That's
Okay.
very emerging market-like
Okay.
scenario, but I
Yeah.
can't rule it out.
Okay. Yeah, I want to talk to you about this real estate because you make a great point. that in the inflation figures that the government uses, they use rents instead of housing prices.
They're lucky they use
That
rents, because if they used housing
yeah, right,
prices, inflation would have
right,
been double digits in 2022.
right.
The
Rent,
case, I'm
yeah.
sorry, the
Go ahead.
S&P Core Logic home price index since February 2020 is up 48%. Rent of a primary residence within CPI is up about 23%. So the Fed is lucky that they use rents
Okay.
from an optics standpoint.
You know, we all know the argument of housing stock and low supply, and you know that's a bull case. Can you come up with a narrative on how the real estate market could begin to decline and even enter a bear market in real estate? Could it be that if the consumer that took their revenge trips last year, you know, Airbnb and a lot of these homes that have been converted into vacation rentals, if they're not being used, that they could be additional supply on the market? And, you know, the argument of demographics being lousy here in the US doesn't exactly jive with the housing shortage. Where are all the people coming? And houses never die, just the residents do. Can you come up with a case that would um, create what a lot of people have been talking about for a few years and they were wrong about the housing market entering a bear phase and prices declining?
Well, I actually would argue that lower home prices would actually be a good thing because, well, not like, of course, it was in 2008, but the housing market's upside down. The pace of existing home sales is at a 30-year low. We need lower home prices to reset the housing market, to give first-time home buyers an opportunity to own a home. Because not only, of course, do you have the 48% rise in home prices, you've more than doubled mortgage rates. You need lower home prices to offset, well, to make it affordable again. Because for every transaction of a home that does not take place, the buyer of that home is not going to repaint the walls. They're not going to be putting down flooring. They're not buying new furniture. The
Right.
seller of the home that's moving into another home, well, that's another transaction that's not taking place. We need more housing transactions, and a decline in home prices is the only thing that will get us there.
How could that happen with the you know, the shortages that we've been hearing about in housing stock? How can we get a declining price structure in real estate? A
We need
recession,
baby
is that the
boomers.
only answer?
No, we need baby boomers to downsize. Now
Okay.
that's not something that happens with a snap of a finger. This is a multi-year process. But you know, the 70-year-old baby boomer needs to downsize. The kids are out of the house. It's time to sell, and it's time to buy a place in Florida. That's what we need in the existing home sale market. But again, as I said, not something that happens overnight. It's a multi-year process.
Okay, you don't think the vacation rental market, as it becomes less profitable and even losses for people that went out and bought a lot of places and turned them into vacation rentals, would be enough new supply to come on the market if they decide they're not getting enough revenue to support what they're paying on the mortgage for their vacation rentals?
No doubt that all the Airbnbers could run into trouble if there's a slowdown in rents, for sure. I can't discount that. I think also another factor that will determine the state of the economy and a byproduct that being housing is what happens to the stock market. What happens if the S&P 500 goes to 3,000 or back to 3,500?
Okay.
You know, that also will impact people's lifestyles. And if those boomers still have a lot of assets in the stock market, if you see a decline in the market that impacts their retirement, then yeah, maybe they'll be more inclined to sell that house. Now, that is more housing supply for wrong reason. So
Okay.
There are a lot of different scenarios that can play out here.
Okay. Interesting. So let me ask you, Peter, about things like, dare I say, NVIDIA. Do you think that we're seeing some topping action in the market? And I want to congratulate you on, I'm sure you're still long metals. Before we get to that, though, can we talk about the stress tests yesterday? Because that also relates to, credit issues with commercial. And so far, you have any reaction to the stress tests? I know that regulators came out and said that most banks are pretty prepared for deterioration of their books if credit on especially the poorer consumer that's pretty maxed out, if they start to walk away from debt, that all the banks are okay.
I had a big yawn when the
Yeah,
stress
big
test
yawn.
came out.
Okay.
There's no doubt that consumer delinquencies are going up for credit cards, for auto loans. We obviously have to pay attention to what the rise in interest rates on a sustainable basis is going to have for corporate credit, commercial real estate. Of course, there are going to be more banks that fail. There's no doubt about it. But it's when you have more than 4,000 banks and you see a vertical rise in interest rates, yeah, there are going to be banks that fail. We already saw that, obviously, March of last year, and we'll see more.
Yeah.
But
So
in terms of
the little banks are history then,
yeah,
KRE.
but what we've seen though is that the U.S. government has essentially guaranteed everyone's deposits implicitly. They're not going to bail out Silicon Valley deposits and then not bail out a mom and pop. That's not going to go over well politically. So if you've essentially guaranteed everyone's deposit, well, if there's a failed bank, then they'll just merge into another one. I think most importantly with the banking system is that they clearly are more focused on their balance sheet. They've slowed the rate of lending. We've seen a notable fall in auto loans. We've seen a topping out and a rollover in real estate loans. They stayed elevated because a lot of the pre-commitments that banks had on projects that started pre-2022 are now finishing up. C&I loans have been sort of in a range, but a lower, it's still down well off its highs. Credit card loans are still up because that's, people are still using credit cards, but that could also be part of, a secular story where people are just using more credit than cash. But I think it's clear that banks have dramatically tightened standard. It's much harder to get a loan. And, but that's been an ongoing story for the past, year plus.
Okay. Is the story changing here? NVIDIA being the darling.
So,
key reversal. Last time we saw something like that was back here. We had about a 20% correction, and then it took off again. What do you think with tech, the concentration in tech? If this is one of the reasons, the most valuable company on the globe, could this be the canary in the coal mine?
well, it certainly is if it falters. I mean, I think, technically speaking, there's no doubt that NVIDIA has gone parabolic. But on, an evaluation basis, valuations don't matter until they do, and they only do when earnings growth rates start to slow. NVIDIA hasn't seen that yet, but just for some perspective, I went back and looked at Cisco's peak price to sales ratio in 2000 was 23 times. I'm sorry, 24 times sales. Now, I don't want to hear what NVIDIA's PE multiple is on 1 year's earnings and someone telling me, oh, it's very reasonable. It's only reasonable if you think that a 76% gross profit margin is sustainable, which it's not for NVIDIA, because you have NVIDIA's biggest customers today trying to develop their own chips, which will then be their greatest competitor tomorrow. So I'd rather price NVIDIA on a price to sales basis. So today's multiple for NVIDIA on fiscal year 25, which ends January 2025, the estimate of $120 billion of revenue, which is double the year before. NVIDIA is trading at 26 times sales. So
Okay.
there's no room for error. Like I said, it's their biggest customers are trying to be their competitors. It's an amazing fundamental story today. The question is what do you pay for that? That's the debate. No one's debating the positive fundamentals of NVIDIA right now. They're robust. The debate is what do you pay for that? And I think we've reached epic height phase in everything AI. Obviously, the CapEx component, which NVIDIA is benefiting from, has been extraordinary. But I think it's highly uncertain of what the payoff is going to be in terms of return on investment and what's the usage. Everyone's going to use AI in some fashion, but is it just a tool that we use along with other pieces of software? I think that's the case, which is still very helpful, makes us more productive, and it will. But technology and software, it's been perpetual pace of innovation that makes our lives more productive. That's been going on since the history of the world.
Yeah, quantum computing can dwarf what AI is. Have you looked into it at all?
Yeah, but to me, that's I can't put my arms around that just yet in terms of timing and what it all means. To me,
you
that's
have to
more
be
of a longer drawn
Oppenheimer.
out. Yeah, it's more of a drawn out part. Yeah, so I can't quantify that just yet.
Okay, and why don't we touch on the commodity markets? They've kind of been in pullbacks. Gold's having a decent day here today, keeps holding this 2280 level. Do you have to be a buyer on breaks, right, Peter? I mean, this is not the end
Yes.
of the run. Same for
No,
silver.
Silver's peak in 2011 and 1980 was 50.
Right
Today
there.
it's 30.
Right.
And gold to me still has a lot of upside. You just inflation adjust gold for the 1980 high, and you're talking 3,200 gold, amongst other fundamental factors that can get it much higher than it is today. So we remain very bullish and long, both the physical and the miners.
Okay. What miners do you like?
The big ones like Agnico,
Okay.
Seabridge, which is more of a development company. And some of the ETFs own a basket of it. So I think you're fine with Newmont and Alamos and Barrick, all the big ones.
Yeah, when you look at Newmont compared to what gold did, it didn't do much, did it? Here's a monthly chart. But GDX, look at this formation, Peter. This was the COVID low and the first rally, and we've been compressing in this huge triangle, and it was turned back at the triangle line. I'm thinking if we pull back towards 30, which is 10% from here, that you have to back up the truck for a buy there for an eventual breakout. The breakout's going to be pretty big too, isn't it? 44, that's 28. You tack on 28 to 34, it gives you like 72, which will take out the 2011 highs.
Yeah, and GDXJ, the smaller miners, the junior miners, there's notable upside as well.
Okay. Do you think that vol is dead, Peter, or is the second half going to be a little messier than the first half?
Probably. When you take a step back on the market here, is that AI gave the market a second wind. There were two things with the market: that when the S&P got to 3,600-ish in October 2022, the bottom in the stock market, the top in the dollar, was when the Fed gave us sort of their last 75 basis point rate hike. And the market sort of sniffed out that from here, the pace of rate increases was going to slow. And then you throw in AI in the beginning of 2023. That is what gave the market a second wind. And here we are now with extraordinary AI valuations that you need the rest of the market to get a second wind, because the Russell 2000 is down on the year. We all know about the divergences. We all know The equal weight S&P is dramatically lagged. Like, you just can't have that disconnect for so long because, and I've said this before, that Google, Microsoft, Apple, Amazon, they don't breathe their own economic air. We all breathe the same economic air. Who's a lot of the customers buying software from Microsoft? It's small, medium-sized businesses. Who's advertising on Google and Meta? It's small, medium-sized businesses. So how can you have those stocks continuously going up and their customer stocks and continuously go down? It's not a sustainable trend. And I know that technical analysts will talk about the implications for that side of where stocks go. I am focused on the fundamental divergences. It's just not sustainable. And I'm hoping that the small mid-cap values markets catch up rather than the big names catch down, which they could. But those are things that we have to watch right now.
Yeah, I know a lot of people coming into this year were so optimistic about the Russell. I mean, people talking about it doubling, and it's still been a disappointment for people long Russell. What could change it? And you know what? I'd like to wrap it with Peter and viewers. Here's Peter's report where you could find his stuff. I get his emails. You need to do it too at the book report. But why don't we kind of focus on what's happening with the dollar, which is a linchpin here. We're threatening an upside breakout here in the dollar. Today we're getting a little down day, but above 650, it's going to look pretty good. I'm currently short the dollar. I'll be out over this level. What would be the narrative for the dollar to break, and would that be supportive, or could we actually have a time where their recency bias is risk off by the dollar? Could we enter a phase where there's risk off and the dollar is lower on risk off because people are leaving dollar denominated assets?
I like to look at the dollar against specific currencies.
Okay.
The dollar yen
Euro.
has its own dynamic based
Right.
on what the BOJ is going to do here. I look at the euro, and you take a step back on a 5-year basis. The euro is traded between, call it 105, dip below par,
Right.
very temporarily in 2022, but it's been traded between, call it a buck and $1.25 for years
forever.
now. And we're kind of stuck in the middle. So what does that tell me? You look at the Canadian dollar. We've been in a trading range for years now. Now the peso has recently weakened with the election results, but prior to that, the Mexican peso was very strong against the dollar. The pound has sort of been in a range for the last couple of years, though down from where it was during the Brexit vote. So, the dollar has its own major issues. And I think that's why, outside of the yen, in terms of the major currencies, hasn't really broke out against anything.
Okay. So basically, central banks have been, what you described was success by the central banks to take the volatility out of currency trading, that they've been able to, all majors have been range bound for a long time.
That's what it seems. I mean, it's been you look, the dollar has been it's been a very interest rate differential factor move here. The dollar bottomed in June 2021, just as Jay Powell said, we're thinking about tapering QE. The dollar topped in September, October, maybe early November 2022, just as the Fed was ending as I said, their last 75 basis point rate hike. It's just been very interest rate differential influences here with the dollar. And now that the Fed's going to cut at some point this year, so that takes some of the steam out of the dollar strength, even though obviously it's bounced a little bit here the last couple of weeks. But so
I'm bearish. I think that, if we start taking out 105, then 104, we're headed towards par. And if we take out this 106.50, probably headed up to 108, 110. So it's at a critical juncture here. just like the yen is. Why don't we wrap it with, I know we have a debate tonight. Do you think this election is going to have any major impact on what happens with confidence in the markets, et cetera? Do you have any views on whether this is just going to be smooth sailing and both sides accept the result and it's not decided by the Supreme Court and the markets, just like they've ignored wars that are escalating, will ignore this too?
I'll say I hope so.
Okay, but do you think so?
I don't think that there's going to be another election issue.
Okay.
I think there have been a lot of on the ground adjustments to this to sort of clean up any possible irregularities that people alleged. So I'm hoping that the system, so to speak, is much more prepared for providing clean outcome that both sides can happily accept.
From your lips,
Well,
Peter.
I should say the winner will be happily accept, the loser won't. But
right.
I'm hopeful that it'll be clean.
Any worries about the escalation of geo risk?
Historically, geopolitics matters for a week because unless it directly impacts economic activity and the disruption of shipments and supplies, it doesn't have an impact. But we've clearly have seen disruptions here. I mean, the Houthis, you're right, the Houthis are resulting in another spike in shipping costs. Obviously, things can happen with Russia and their delivery of energy. So more so than in a while, the geopolitical threats here are lasting longer than what it does normally.
Right. So if the Houthis can disrupt shipping, what could the Iranians do, which are, they're puppet masters?
Well, what's most scary in the world we're in now is all you need is a drone to cause a major disruption.
Yeah. Okay. So I really appreciate you being here, Peter. And the yen is, I'm break even from yesterday now. Anyway, it's always great to talk to you. I encourage people to go to Peter's book report. I mean, what you're getting as a retail guy is stuff that institutions pay for. So appreciate you, Peter. Thank you very much for edifying the community and answering every question I throw at you.
Dale, I appreciate having me on as always.
All right, buddy. Have a great summer. We'll talk in the fall.
Sounds good. Thank you.
Peter Bookfire, everyone. Follow him on X at pbookfire. And that's going to be a wrap for us today. Good hunting, everybody. The rest of the day, we'll wrap it up with the inflation number and TGIF tomorrow. Don't just count your barrels of oil or your coins or your pips. Count your blessings. Adios, everyone. Thanks again, Peter.